All right, let's dive right into this explainer and totally demystify the foundations of investing. Whether you're saving up for a dream vacation, maybe a new home, or just trying to secure your retirement, terms like stocks and bonds can sometimes feel like a completely foreign language. But today, we're pulling insights from the SEC, FINRA, and Fidelity to build you a clear, step-by-step roadmap to financial freedom. And don't worry, if this all feels a bit overwhelming at first, here's our game plan for today. We'll start with getting ready to invest. Then we'll explore the investment menu, figure out your allocation and diversification strategy, understand the risks and taxes, and finally, choose the exact right account for you.
So let's jump straight into part 1, getting ready to invest.
Before we go out and buy anything, we really need to hit pause and build a solid safety net. The experts over at Fidelity actually suggest starting with a small emergency fund first, about $1,000 just for those completely unexpected short-term events. Like a surprise vet bill or a blown tire. Once you have that, work your way up to a much larger buffer of 3 to 6 months' worth of essential living costs to protect yourself just in case of a job loss. And then, it's time to aggressively tackle that high-interest debt.
Now, speaking of debt, there's this really crucial 6% rule of thumb you should know. Basically, if the interest rate on your debt is 6% or higher, you've got to pay that down first. It's a priority. But if it's less than 6%, you can usually just make the minimum payment and definitely consider investing those extra dollars instead. Why? Because at those lower interest rates, there's a really good chance your long-term investments are going to give you a much bigger bang for your buck than paying off that cheap debt early.
All right, moving right along to part 2, exploring the investment menu.
Let's start with the most famous ingredient out there, stocks, also known as equities. When you buy a stock, it's pretty wild. You literally own a piece of that company. And your returns generally come to you in 2 different ways. There's capital appreciation, which is just when the stock price goes up, and then there are dividend payments, which is when the company decides to just hand a slice of its profits directly back to you.
Now, look at the contrast between your 2 main options here because it's super important. On one side, we have stocks. Historically, these carry the greatest risk but offer explosive potential for growth. They are absolutely the heavy hitters of your portfolio. On the other side, we have bonds. Buying a bond is essentially you playing the bank. You are loaning your money to a company or the government in exchange for much steadier but usually more modest returns. Way less volatility here.
But hey, what if trying to pick individual stocks and bonds just sounds way too stressful? Enter the ETF, or exchange-traded fund. I like to think of an ETF like a food truck combo platter. Instead of agonizing over whether you want the sesame chicken or the beef and broccoli, you just buy the combo platter and get to sample a little bit of everything. By buying just a single share of an ETF, you get instant exposure to a whole basket of investments, which naturally lowers your overall risk. Which brings us nicely to part 3, allocation and diversification strategy. Check out how this pie is sliced up. This right here represents asset allocation. It's simply the strategy of dividing up your portfolio among different assets, and it should be driven almost entirely by your time horizon. So if you've got decades until you retire, you might be totally comfortable holding a massive slice of stocks. But if you're planning to buy a house, say, next year, your portfolio needs to be heavily weighted towards stable cash and bonds.
And this next concept brilliantly illustrates diversification. Just picture a street vendor who sells both umbrellas and sunglasses. Sounds a bit random, right? But it's actually genius. When it's pouring rain, the umbrellas sell out. When the sun is shining, the sunglasses fly off the table. By diversifying, that vendor makes a profit regardless of what the weather is doing. Investing works the exact same way. You spread your money around so that if one specific sector takes a hit, another one might be booming and making up for those losses.
Here's the catch, though. Over time, the market is going to completely warp your initial, carefully planned pie chart. Your stocks might go on a tear, and suddenly they make up 80% of your portfolio instead of 60%. So every 6 to 12 months, you need to do a little maintenance called rebalancing. Basically, you skim off some of those current winners and use that cash to buy more of your current losers. I know it feels totally counterintuitive to sell what's doing well, but rebalancing actually forces you to do the smartest thing in investing: buy low and sell high.
Okay, let's get serious for part 4, understanding risks and taxes.
Because, as the saying goes, no pain, no gain. Every single investment carries risk. You face business risk, which is the chance a company goes bankrupt. There's volatility risk, which is just those stomach-churning daily price swings. You've got interest rate risk affecting your bonds, and liquidity risk if you suddenly need to sell an asset but can't find a buyer. But you know what the real silent killer is? Inflation risk. That's the danger that inflation is just quietly sitting there, eroding the actual purchasing power of your supposedly safe cash over time.
Now, let's talk taxes. When you make money and sell an asset for a profit, Uncle Sam is absolutely going to want his cut. But timing is literally everything here. If you buy and sell an asset within a year, that's a short-term capital gain, and you're getting taxed at your normal, higher ordinary income rate. But if you practice a little patience and hold that asset for more than 1 year, it becomes a long-term capital gain, and your reward for waiting, your tax rate drops significantly, usually down to 0, 15, or at most 20% for the vast majority of us.
But get this, there is actually a pretty sweet silver lining in the tax code for when things go wrong. According to the IRS, if your capital losses end up being more than your gains for the year, you can actually claim an excess loss to lower your ordinary taxable income by up to $3,000. And if you happen to lose even more than that, you can literally carry that leftover loss forward into future tax years.
We're in the home stretch. Part 5. Choosing the right account.
It's time to take all this knowledge and pick your launch pad. You essentially have 3 main options. First, the 401k or 403b through your employer, which is amazing because you often get an employer match, and that is literally free money. Second, a standard brokerage account. This offers total freedom and immediate access to your funds with 0 contribution limits. And third, an IRA. You open this one up yourself, and it comes with fantastic tax perks, like the ability to withdraw your contributions completely penalty-free if it's a Roth IRA.
But please listen very closely to this piece of advice from Fidelity because it's a trap so many beginners fall into. Simply depositing your money into these accounts is not enough. Think of the account as just a grocery basket. You still have to take the vital next step to actually put the groceries in, meaning you have to purchase the stocks, bonds, or ETFs inside the account. If your cash is just sitting there uninvested, it's not growing at all. And remember that silent killer, inflation? It's just slowly eating away at your hard-earned money.
So, as we wrap up this explainer, I want to leave you with one big question. What is your why? Seriously, is it traveling the globe, finally buying that dream home, or just knowing you'll have a comfortable, secure retirement? Figuring out that specific goal is the compass you need to determine your entire strategy. You've got the roadmap now, but remember, building wealth is a lifelong journey. So, what specific asset class are you going to dive in and research next to fund